Hey, good morning, everyone. Marty Mazzora here. It is May 14th, 2025, Wednesday, with your midweek market update. So today I'm gonna do it backwards. Today I'm actually gonna start with the charts and then go to my notes. And the reason I want to do that is because I want to show you, at least in the equity market, what has suddenly turned into what I would call a very positive technical look or action in the price action that shows up at least on the daily chart. Okay, so this is the price chart of the S&P 500, and remember back in here I talked a lot about these retracement levels. This was 61.8% of that 20% decline, and that and the 200-day moving average is typically where I think I said bear markets go to die, and that there was lots of resistance right in here, and that the market was looking pretty heavy, and so on and so forth. Well, we had a monster gap this week, Monday, that just shot right through the 200-day moving average, bounced right off of that 61.8 retracement. It followed through a bit yesterday, struggling to hold it here today. And also notice that the moving averages, even though the 50 is still below the 200, they're both beginning to slope back higher. So in technicians land, these are positive developments. Also, the momentum indicators that we track, the relative strength index, is not yet in overbought territory, although we're getting close. But we don't have any bearish divergences. In fact, this is bullish. We're not showing that we have an upward trend here with a downward trend in momentum. And in fact, momentum has accelerated along with this rally to the upside. So that is a net positive. Does it mean that the next move is up to new all-time highs, say, over the summer? Very well could, and I'm not kidding. Does it mean that we're out of the woods just yet? Probably not, and I think that's going to come up in the commentary that I'm going to share with you, or the notes that I'm going to share with you here in a minute. Could this be a failed breakout like I showed you in other bear markets? That we had the initial decline, we made up almost all of the upside only to roll back over? Sure, it could be anything. I mean, we're going to remain open to all possibilities. Right now, just looking at the charts, nothing else, this is a positive development. Same thing with the NASDAQ 100 or the ETF that tracks it that we follow. It was heavy resistance here at the 200-day, screamed through it. The 20-day has now recaptured the 50-day, sloping strongly higher. That's obviously a short-term indicator, and we're getting upward slopes in these. And we don't have anything bearish here. Getting close to being overbought on the RSI, but we're not there yet. And by the way, the big move on Monday, and the reason for all this was a complete and utter surprise for the markets. On Friday, the president said he was thinking 80% minimum tariffs on China right now makes sense. Scott Bessent, in his weekend negotiations with China, came back with a 30% tariff for the next 90 days while they continue to talk, and he did say he doesn't see it going lower than 10%. Well, 30% and then 10% is a heck of a lot lower than 80. So everybody who was expecting something that would not remotely be positive coming from the weekend, who was short the market, had put exposure on, either hedging or trying to exploit what was expected on Monday, got a surprise. So now, folks, that harkens back to the short covering scenario that I often bring up on days like this when there's sentiment is very negative and suddenly you get a positive news item or something and then kaboom. That was destined to happen on that news. Make no mistake. The news was completely and totally different than what the market was led to believe or what should have believed based on commentary. And therefore, those who were betting that we were going to get something like a 60 or 80% tariff on Chinese goods were betting on the negative. And then, of course, as I've explained, you can't be short in an upward moving market. So you had all that buying to cover those shorts. You had options dealers having to cover their short positions and so on. Then if you get this positive momentum and folks start getting bullish and in the option space start buying calls, well, then the options dealers have to buy the underlying security, and that gives more oomph to the market. So it's not all about, let the pigeons loose and all the risk is gone. Structural, under the surface type things that are going on with leverage, using derivatives, are impacting and exacerbating the moves, and they do exacerbate those moves in both directions. So some of this is just that, frankly. Okay, so one of the ramifications, and this is what I keep warning people about, of good news and tax cuts coming and all this stuff. Gosh, it all sounds great, and I'm going to touch on it in the notes. But look what it's doing to interest rates. Okay, so we know how interest rates can be problematic. They were very problematic in 2022. What this says is that the bond market is discounting growth and probably higher inflation. And higher inflation against already historically high valuations in the market, it makes for, a heavy market from that perspective. Okay, so from the price action, the technical perspective looks good. But to what extent can this market and these valuations actually survive much higher interest rates? And this is a 10-year treasury, folks, and that's, that directly impacts things like mortgage rates and so on. So something to keep a very close watch on, and I'll probably touch on that here again in a minute. The dollar was rising with interest rates. Remember I said this looks like a dollar that wants to go higher, broke through that trend line, and now we've come off of it here the last couple of days. And from what I understand, while the U.S. is negotiating with Asia, with South Korea, Taiwan, and so forth, they are demanding that they strengthen their currencies and i.e. weaken the dollar in the process. So that may explain largely what's happened the last 2 days. As interest rates have gone up, which tends to be bullish for the dollar. Not always. We also have situations where rates can go up and people are exiting U.S. securities. Now, U.S. securities are actually been doing pretty well, at least U.S. equities have of late, so maybe that's not going on at the moment. But we're going to talk about that phenomenon here as well in a minute. So gold has now finally broken down below the top of this wedge pattern, essentially right here. And remember, we were pointing to this right up here. This was kind of an island reversal pattern. I said those can be very ugly. I said this is looking like a double top to me. And right now, that's how it's playing out. So the gold gapping down again today. And this was just a very, very high probability pattern with these big bearish divergences on momentum. We'll see how far it plays out. We're not getting killed. We're feeling it. But for example, the gold is down 2%, essentially just a little shy of 2% this morning. Our position is down 1% because our hedge is offsetting half of the decline right now. And the further it goes from here, the better our hedge looks. So we're feeling good about having hedged that position up in here. Okay, so enough with the technicals. In summary, looking pretty positive here recently for equities. Now, let me pull over my notes, and I'm just going to kind of run through these. I won't take all day, I promise. First of all, yesterday, Peter Bookvar does a great job going through all the earnings statements, conference calls, and so forth, and he pointed this out, which I'm sharing with you, and I'm calling it two CEOs, two different takes on current general conditions. Steinwood Properties CEO says the economy is going to weaken. I just was talking to CEOs of Fortune 100 companies in the past few days returning from the West Coast, and there will be issues on shelves and there will be prices for consumers to absorb. And you kind of already were in a recession. You kind of saw it at the lower half of the country. And the top 10, 15% of the country was carrying spending in consumption. And I've been making that case for quite some time. And now we'll see how the wealth effect actually plays out. Remember I said if you lose that upper income group because their portfolios are declining or they start to get worried, that's where you lose the economy or that's where you lose the expansion. Actually, the markets have recovered shockingly to pre-Liberation Day highs, but that doesn't really feel right. And things like travel are clearly off. I guess it was Expedia that reported and then Airbnb. And we've seen the travel numbers. The airlines have talked about their stress as international travel in the United States dissipates. But it will go somewhere. So Canadians will go to Europe or they'll go to the Caribbean. They will not come here. So I did mention that I think it was United or was it American Airlines, and probably both, that are actually beginning to cut flights. First class is booked, but coach isn't, and they're beginning to lower their flight capacity or the number of flights available to people to adjust to this slowdown in air travel. Now, on the other end of the spectrum, James Dolan with Sphere Entertainment says Las Vegas has over 40 million visitors every year so far. We've seen that the international accounts for a little over 20% of the guests to Sphere and 10% for concerts. We really haven't seen any change, so I think there's a little going on in our economy with that, right? Maybe later on we'll see some substantive reaction from the marketplace, but right now we're really not seeing it. So, and even if we did, it doesn't account for that big of a difference, right? And I think in general, when it comes to concerts, demand exceeds capacity. So they are speaking to international tourism, if you will, but clearly Vegas hasn't been suffering. And I've heard this from other places as well. So folks who have money and want to go have a good time and they like the Vegas scene aren't holding back. It's like people are still paying for much more expensive seats in the airlines. Those who can afford to have fun are still having it. And that says something. And the question is, how long will that continue to last? Will things change? And will the other 85% of Americans, or I'll say 50% of Americans who are really hurting out there, will their lots improve in the near term? And how long can we continue with this big, as they say, K-shaped economy, if you will? And just think of the letter K. You've got, half of the people going up and the other half going down economically. Okay, so I've been making the point a lot lately that a lot of the capital that's flown into U.S. equities the past several decades, in fact, has come from investors outside the U.S. It's 70 cents on every dollar that's flown to the U.S. market has come from an international investor, a recent study showed. So this is, I think, something that's very, very important and something we should be paying very close attention to. We certainly are. And again, it's Peter Bookvar expressing the point that non-U.S. investors have been massive contributors to the success of the U.S. market to this point. Norges Bank manages the world's largest hedge fund, by the way. And here's from Bookvar. Below are the top 10 holdings of the investment arm of Norwegian Central Bank, the Norges Bank, as of December 31st, to make my point of how overexposed at the peak foreigners had to U.S. markets. As the Mag 7 trade is likely over, as you've heard me argue over the past 3 months, and the action reflects this, foreigners are finding other things to buy, and of course, they have gotten shocked by our trade war. So, largest sovereign wealth fund on the planet. Top 10 holdings: Microsoft, Apple, NVIDIA, Amazon, Google, Facebook or Meta, Broadcom, and so on. Eli Lilly down here, Tesla, Taiwan Semiconductor. But 9 of the 10, right, are U.S. companies. So, folks, this is, I think, a precarious spot to be in a world where the U.S. is really trying to redo the global trade balance and lower the trade deficit and this and that. A lower trade deficit means less capital floating around out there with which to come back and buy U.S. assets. And then in the Financial Times, Chief Investment Officer of the Australian Pension Scheme, Eunice Super, said in its podcast last month that his fund had quite a large exposure to U.S. assets and would be questioning that commitment. He said, I think we've seen the peak investment in U.S. assets. Danish pension funds embarked in the first quarter on their first sale of U.S. stocks since 2022, making their largest purchase of European-listed security shares since 2018. And I have told you folks, and I've certainly been illustrating for you in review meetings, that our not small exposure to Europe, because we did anticipate a rotation, if only for pure valuation, and economies kind of sit in the economic cycle, although Europe's not doing so great after all this year, but their stocks are up significantly. In fact, our European ETF is up like 20% this year. So no doubt we've seen a rotation out of U.S. equities into European equities. Lastly, Sam Linton-Brown, head of macro strategy at BNP Paribas, had a thought experiment according to the article. If European pension funds were to reduce their allocation to 2015 levels, that would equate to selling as much as 300 billion euros worth of U.S. assets. Okay, so bottom line, we're talking about the pendulum swinging in the other direction from the extreme U.S. global love that peaked in January and mean reversion inflection points is what is being discussed here. Highlights of the S&P Investment Manager Survey. I actually participate in that. They send me the survey. I answer the questions, so we get an early peek as the results. And let me just kind of sift through this and highlight it for you. Worries grow over equity fundamentals amid lower earnings expectations. Sector preferences remain defensive, and energy sector sentiment hit its lowest since 2022. Equity investors remain highly risk-averse in May as concerns over geopolitics and macro environment continue to dominate. I think I'll stop there. Essentially, that sets the stage, right, for a big fat Monday rally, right? Because you're hearing investment managers have been bearish, probably a lot of them short, and therefore they probably panicked to some extent on Monday. We didn't, obviously. And then, as I mentioned, when we're looking at the charts, the bullish case for fiscally stimulus federal spending bill would be that it's bullish for spending. Let's throw a bunch more money in the economy. Let's cut taxes. And it notably reduces the odds of recession. No ifs, ands, or buts about it. The bearish case is that the budget deficit will deteriorate further. It'll actually accelerate. Potential for a fiscal crisis that would show up in the bond market. Rates rise with inflation, a mess for consumers as well as for the government rolling over volumes of debt, and investor sentiment falls. So this is really at odds with the administration's goal of reducing the deficit. What they're talking about would accelerate it notably. So, and that would be positive for interest rates, meaning it would push them higher, positive for inflation, meaning it would push it higher, all things equal. And then lastly, let's just explore the whole tariff situation. I mentioned that the market rallied, as you know, on the agreement for 30% tariffs, which is huge come down from where we were, and then ultimately 10% is where we're going to end up, we think. Clearly, the administration does not have the economic or market pain tolerance to follow through on Trump's ambitious objective to entirely redo the global trade matrix. That just can't happen without tremendous amount of pain that any politician would have the toughest time absorbing or stomaching. Therefore, even the 30% tariff on Chinese goods won't ultimately stick, as that, reduction notwithstanding, would be destructive in our view. Not everybody agrees with me on that, but I think it would be. For now, it appears as though a 10% on all imports is Trump's bottom line, which by itself, by the way, takes us back to the Great Depression days. Smoot-Hawley was 1.3% of GDP. 10% on all imports today would be 1.4% of GDP. Not a recession, as it says here. Not massive in a raw fiscal sense, but it is a big deal economically. Perspective, 1.4% of GDP equals $400 billion in 2025 terms. Federal tax revenue is projected at 17 to 18% of GDP, so 1.4 is less than 10% of total revenue. Is it roughly the size of the U.S. defense budget increase in some years, or equal to the entire federal outlays for education? By itself, it doesn't shift the fiscal balance, but it's not trivial. Indirect costs. Tariffs raise prices for consumers and businesses, especially import-dependent one. It therefore lowers real income, creates higher production costs, potential slower growth, and retaliation we need to look at, because the Smoot-Hawley sparked a big global trade war, and that's really the mess that we get. And we're seeing that today. Distortionary effects. A 10% tariff across the board distorts markets. It reallocates resources inefficiently. It's not letting the market dictate where resources go anytime government steps in like that. Could slow investment in globally integrated sectors. Inflation risk, direct pass-through of tariffs on consumers could add several tenths of a percent to CPI. In a fragile disinflationary environment, that complicates Fed policy, triggers retaliation, and so forth. Smoot-Hawley revenue was 1.3%, but its economic impact was catastrophic, not because of size, but because of the shockwaves through trade flows, retaliation, and confidence. The first tariff, the first Trump trade war one, was about 0.5% of GDP, and we got that year, 2018, we had 10 and 20% corrections in the market, respectively. And then we break it down by sector, and I'll just, in the interest of time, we don't need to go there, but when you look at it sector by sector, the big players in the big sectors have lots to be concerned about. For example, $35 billion in annual cost estimated to the automotive sector alone. So folks, the way to kind of get our heads around this, I think, is that the administration clearly wants to extend the tax cuts that are set to expire this year and actually lower taxes even further. I do believe that they see the 10% across the board tariff revenue as a source to offset that, and it will. It will definitely generate revenue, no doubt about it. And that they believe that the negative effects, which I just briefly outlined here, of the tariff can be offset by the income tax cuts that they want to put forth. So in that scenario, we cut income taxes. We don't hit the budget quite as hard because we have the tariff revenue coming in, and we reignite animal spirits, and we get this economy rocking and rolling. But what's that going to mean with 10% higher costs, with a growing economy, with growing animal spirits? What's that going to do to interest rates, and what's that going to do to inflation? And ultimately, does this U.S. market get to, I guess, a new sustainable bull market? What I showed you last week about where bull markets tend to begin from a valuation standpoint, or always begin, or where bear markets tend to end, the current valuations are a big headwind to that narrative. It does not mean we don't go to new highs over the summer. The technicals say that is a distinct possibility. Everything else I shared with you today says that, there's still some risks out there, and we need to not act as if everything's great, stocks are cheap, and we're going to the moon from here. I'll leave it there. Folks, thank you as always for watching and listening. I'll be back at the end of the week. Take care. Bye.